Hi everyone. In our previous video, we spoke about how US companies, though they are not profitable, how they continue to remain at very high valuations, why people keep investing in such companies. Now, in this video of the series, we'll talk about how to value tech companies that are actually not profitable. So we typically look at metrics like a price to earnings ratio, cash flow, EBITDA, enterprise value, etc., to find out the valuation of a specific company, but these companies are not profitable. So how do we value them? So this video talks about it for all these tech companies that are going to remain critical in our Indian stock market. So let's look at some of the Indian tech IPOs. So Zomato, Nykaa, Flipkart, Ola, all of them have been coming up with IPOs. So Zomato came, Nykaa is profitable, while PolicyBazaar is also slightly profitable. All other companies are not profitable. For example, Delhivery is trying to get into the profitability zone. Ixigo is trying to get into the profitability zone. So almost 90% of the companies are not profitable. So first, should we invest in them is one question we answered in the previous video. Number two, how do we value them based on the current numbers that are available that are not based on profits? So now let's look at some of the metrics that are traditionally used. EBITDA growth is something we typically use to value a company, but these companies are not even EBITDA positive, leave alone net margins. Even EBITDA margins are negative for many of these companies. We also look at free cash flow as a metric. Free cash flow to market cap is one metric that is very, very critical in terms of valuing and analyzing a company. But these companies may not have free cash flows as well. Then how do you value them? So we typically also look at other metrics like debt to EBITDA. Again, EBITDA may be negative for these companies. So EV to EBITDA. This is another metric that is again not available for us to value these companies. So what is the only way to value these companies and find out what is the true value of a Zomato or a Nykaa? Revenue growth. So having a multiple attached against your sales growth is a method that is widely used to value tech companies globally. So this is the tried and trusted formula to find out the valuation of a specific tech company. So find out how much revenue. Let's say a company is making 100 crore revenue, and if you give them a valuation multiple of 15x, then it can be valued at 1,500 crore, which is a fair valuation for the company. Now, let's look at how to calculate these valuation multiples. So first thing, have a specific base multiple, which is typically 6x to 8x. So 6 times sales can be given to a company on a traditional basis, which is your base. On top of it, you can add additional multiples to companies based on their performance on various metrics. So we are looking at these metrics. The first one is sales growth. If a company is continuously growing at a very good rate, that is greater than the median sales growth rate of the industry or of the company, then you can add additional multiples to value this company. In case if the sales growth is poor, if it is not growing at the industry standard, then reduce the multiple. Next thing, opportunity size. So we have to also check how big is the opportunity size, how many players are there, how many competitors are competing with them. So if the opportunity size is extremely high, keep adding more multiples to the valuation. Next thing, sales growth versus cost of goods sold. So unprofitable companies, though they don't have profits to show, they're expected to show a sales growth higher than their expense growth. So if they have huge expenses, but if they are able to grow at a rate higher than your expense growth, then it is a positive signal. You can add additional multiples to value these companies. So the next important metric is cost of acquiring a customer. So this is nothing but very simple. So how much cost you are spending to get a new customer divided by the number of customers added during the period. So if your cost of acquiring a customer is less than industry average, it is a worrying sign for a company. You can, if the cost of acquiring a customer is less than the industry average, it is a positive and healthy sign. you can add more valuation to this company. Whereas the cost of acquisition is very high, then you have to reduce the valuation a bit. The next thing is lifetime value. So after acquiring a customer, how much lifetime value is generated from the customer? So how much monetization you can create through these customers who have been acquired through multiple channels like sales and marketing. So LTV is lifetime value, which can increase through upsells and retention. So this is one more metric we have to consider. So net retention is specifically for B2B industry. We can talk about it in detail when we talk about B2B companies. So a good LTV, a low CAC, and a superior retention metric can result in a very high valuation for a tech company that is not profitable. So these are key things that you have to consider if you want to invest in tech companies. So typically an LTV has to be greater than 3 times of cost of acquiring a customer. So if this is the case, then the company is a very good investment opportunity to bet on. So So if the company is spending more money to acquire a customer, whereas if the lifetime value is very low, then this company is not having a sustainable business model. It is not going to become profitable at all. So they'll keep burning cash. They'll keep getting customers who will not be able to give you more revenues. So the cycle keeps happening. They'll keep on burning money, and eventually this will result in the company getting shut down. So there are a lot of examples for this. We'll look at it in detail in another video. So a successful business model in tech companies is this one. So the cost of acquiring a customer is low, whereas the lifetime value of this new customer is very high. So if this is achievable, then the company is a very good investment opportunity. So through digitization, we are able to get a lot of customers at a very low cost. So several new businesses have come to existence primarily because of this. Next thing is you can monetize your customers at a higher level than the cost. Only if you're able to do that, invest in that company. If a company is burning, so company can remain loss-making company for a few years. But if there is no path towards profitability, if there is no path towards generating profits in the long run, then those companies are those are red flags. Those companies are not investable opportunities. So always look for a healthy LTV, CAC, and payback period. All these are extremely important if you want to scale a B2C business. So now let's look at how to value and do a calculation. So I'll take an example. So the other metric that you have to consider is sales efficiency index. So how efficient is your sales team? How are you doing sales? Is it digital? Is it virtual? How have you been able to get more customers? So how much revenue you are generating divided by the sales and marketing expenses for the period. So this is kind of a reverse of cost of acquiring a customer. So sales efficiency index is very, very important. It has to be always greater than 1. Anything more than 3 is exceptional. If this number is less than 1, then it is a red flag. Do not invest in such tech companies. So if a company has a leadership position in a market, for example, Zomato is a clear leader in the space. So you can add additional premium because they tend to have strong moats. They have sustainable competitive advantages, which have been used to make sure that they remain leaders. So if they are operating in a niche, they are likely to do well as well. So you can add additional multiples for such companies that are operating in a niche because they will eventually become profitable. There is no question about that. Now, let's take a sample example and find out how to value a company. Let's say a company, we are valuing a tech company. So the median valuation would be 8x, 6 to 8x you can put. So here I've put 8x. The company is showing extraordinary growth, 163% CAGR in the last 3 to 5 years, which is phenomenal. Since the company is growing really well, I'm giving additional 3x valuation for this company. Now let's compare sales versus operating expense CAGR. So Here the sales CAGR is higher than operating expense CAGR by 56%, which is very, very good. Though they are burning cash, the revenues are growing very fast, which is a healthy sign. So in this scenario, I'm basically giving an additional 2x valuation here, primarily because the sales numbers are far better than the amount of expenses. The next thing I typically look at is FCF, free cash flow. So is the free cash flow improving for this company? Are they going to have positive free cash flow over the next few years? So if there is an improvement, I'll add additional one next. In this case, there is no improvement. So I'm reducing the valuation by -1. So next, look at the opportunity size. So the opportunity size for this particular sector and industry is $102 billion, which is massive, and it is a sunrise sector. And the current market captured is only around $15 billion, which is like around 10 to 15% of the total market that's been captured. So this is a massive potential opportunity. So I'm giving additional 3x valuation. Now let's look at a sales efficiency index. This is poor. So the company is spending a lot of money on sales and marketing cost, but the sales is not great. So I'm reducing the valuation by 1. So next let's look at retention and LTV. This is again less than 100. 56 is very poor. So I'm reducing the valuation by -2. So is the company a clear leader in this space? Yes. So number one in this space. So I'm giving additional 2x. So overall, if you look at the space and this particular company, so this company is can be valued at, so you can add all these numbers, 8 plus 3 plus 2 minus 1 plus 3 plus 2 minus 2 minus 1. So this comes to around 14x. So I'll give a valuation of 14 times sales for this particular company. And since the company is having a sales of 1,100 crores, I'm giving a valuation of 1,400 crores for this company at 14x valuation. So this is how you should look to value a tech company. If you look at numbers, right, most of the companies in India are trading at very high valuations. We'll take real-time examples individually and look at these valuations. Whereas if you look at the US markets, similar companies are trading at lower valuation like 6 times, 8 times sales, 15 times, 14 times sales. Whereas in India, there is a huge premium that's been paid, and these companies are trading at sky high valuations. But we have seen a healthy correction. We have to see if there is an opportunity in this correction to add these companies into our portfolio, which we'll discuss in another video. Now let's look at this. So median valuation, I'm giving 8x. So if you look at this, 8x plus 3, here sales versus operating expense is a positive thing. So plus 2, 8 plus 3, 11, 11 plus 2, 13, 13 minus 1 because poor cash flow is 12. 12 plus 3 is 15 because of the huge opportunity size. Sales efficiency index is poor, -1, 14. So retention and LTV is poor, -2. So 12 comes to around 12. And then since it is a leader, I'm giving additional 2 points. So overall, if you look at it, it can be valued at 14x sales. So this is how we should value these tech companies. Now, I hope you got a good understanding of why these companies remain loss making. Number two, we also looked at the US market to see how it works in the US market. Now, we have seen how to value these tech companies that are not profitable in this video. So in our next video, we'll take real life examples like companies like Zomato, Freshworks, Ixigo, etc. We'll take real life case studies and value them in the next video. So if you want to understand them with real numbers, feel free to subscribe so that you can catch up our next video on time. Thank you.